Good morning, it's Jeffrey, Christian CPM Group. It's about 9:30 on Friday, the 28th of January in New York. We've had quite an interesting week in the financial markets, and I want to unpack some of the realities of what we've seen versus the emotions that we've experienced. We've gotten a lot of requests for comments about interest rates, real interest rates, Fed policy, the dollar, equities, and I'll go through those things. We've gotten requests for other comments about various things, non-existent large short positions in silver, why it is that the silver price didn't go over to $50 the way certain people promised. But let's not focus on that. Let's talk about the real markets and what's really going on. Now, I wanted to start with this comment, because there's a lot of fear in the market. Amanda Gorman, who is she was 22 years old a year ago. She's 23 now. Wonderful poet who gave a tremendous poem at the inauguration last year for the President of the United States. She had an editorial or an opinion piece in the New York Times on the 23rd. And she talked about how she was very much afraid and almost backed out of giving that poem out of fear that she wouldn't do a stellar job, fear of the insurrectionists who were threatening to attack the inauguration, and just general fears. And she said she overcame those fears, and she was glad she did. And in that op-ed, she had the line, "Now more than ever, we have every right to be affected, to be afflicted, and to be affronted. If you're not afraid right now, you're not paying attention." And I thought that was a great quote, which is why I copied it and I'm using it right now. And the key going forward is, how do you channel your fear? What you should do is use it to mobilize yourself for your own protection and for that of the various communities that you are a member of, your family, your local community, your state, the world. You shouldn't let that fear wash over you and give in to the fear mongers and the revival tent snake oil salesman telling you, please stop thinking clearly, start thinking irrationally, or continue thinking irrationally. Take our advice, even though we've been wrong our entire career, whether it's been months and years, like some of these guys, or decades, like some of these guys. They're talking about an 80% decline in the stock market. They're talking about the collapse of the dollar or the skyrocketing of the dollar. They're talking about all sorts of stuff that really are not rational. Take a deep breath, go down the hall, think about what you're hearing, think about what you're seeing. CNN had a great headlines yesterday. CNN had two headlines almost next to each other. One said, "Oh, the financial world, the world is collapsing." And the other one said, "Oh, the United States had the strongest real GDP in 2021 since the Reagan era, coming out of the 1980, 1982 double dip recession." True. Yeah. Don't let the fear wash over you. Manage that fear and use that fear to think clearly and act smartly. So I wanted to talk about interest rates first, the Fed funds rate, and gold. People asked about it. We've seen the Fed say things this week that are not new. They have been saying for months, if not quarters, hey, we're going to start withdrawing monetary accommodation. The fiscal stimuli are still there, but we're going to start withdrawing it. And maybe we're going to accelerate it because inflation has been stronger than the Fed thought it would be. So that really hit the markets. And one of the questions we got was, well, what's the relationship between the Fed fund rate and gold prices? Here you can see the effective federal funds rate, which has been bouncing along zero for much of the period over the last decade or so. And you can see gold prices. And you might argue that there's a inverse relationship. When we had very high Fed funds rates back in previous decades, we had relatively lower gold prices. It actually isn't cause and effect. I mean, one of the reasons why we had low gold prices is because we were coming out of decades long, centuries long fixed gold prices, and the gold prices were only beginning to adjust to being freed to float and find their proper level. So it kind of looks like it's there. Now look at that Fed funds rate. Let's talk about what the Fed's talking about doing. Raising interest rates to 1%. That's down here, right? Lower than any time since 2000, before 2003. Let's say that they have to double their bets. Oh, lower than any time since 2002. Fed funds rates and consequently other short-term interest rates are not going to rise so fast as to disrupt economic activity. If you look at what happened back here in 1979, 1980, when Volcker said, let's kill inflation, which was running at 14%, that was a high Fed funds rate. And it didn't really actually put the kibosh on gold prices. So, but the key to understanding the relationship, this is apples and oranges. Interest rates, gold prices. Cost of money, the cost of gold. What you really need to do is look at the percent change month to month of interest rates, the Fed funds rate here, and gold prices. And there, the relationship is 0.4%. So the bottom line is, don't fear the reaper, or maybe fear the reaper, but don't fear the Fed. The Fed knows more about what it's doing than the fearmongers on the internet who have been waving their arms for 40 years now, saying that the Fed doesn't know what it's doing, but they do, and it's all going to be bad. Interest rates are not that bad of an issue right now. In fact, they're pretty good because they show that the economy is, in fact, strong and recovering, and there's a great increase in demand, not from the 2020 recession, but from the pre-pandemic and recession period. Demand is very strong across goods and services, and it's causing prices to rise. And the Fed is leaning into that wind and probably effectively managing it. We always talk about how interest rates, when you're looking at interest rates, one of the things that's important is why are interest rates rising? And another factor is how high are they? They're very low. They're not going to be particularly negative. And right now, the financial markets are looking at the Fed's plan to raise interest rates, saying, okay, the Fed sees inflation and the Fed has the tools and the talent to control that inflation and get it under control and bring it back down. I would add, in addition to that, there are other factors that have nothing to do with the Fed or monetary policy, which will reduce inflation too. So the markets right now are saying inflation is a problem, but the Fed probably will control it effectively. Ergo, let's sell off some gold and silver this week. Now, the dollar, one of the comments is, oh, the dollar is going to collapse. And another comment that we've gotten is, oh, the dollar is likely to strengthen sharply in the near term. And you can see here, the dollar's really been trading in a range for almost a decade now, right? 8 years. And it moved to the high end of that range going into the recession. It dropped toward the low end of the range last year, and now it's coming back. The dollar, in our view, is likely in the near term to move sideways in perhaps a little bit more volatile pattern than it has been in the last few years. But for the immediate future, we think the dollar stays in that range that it has been in for the last many years. We don't think it goes back to where it was prior to 2015, and we don't think it goes back to the highs that we saw earlier. So the dollar short term probably isn't going to collapse, probably isn't going to skyrocket, probably isn't going to have a major effect on gold. And historically, the correlation is 33%. So 67% of the time, 2/3 of the time for those who want to do the percentages, 67% of the time, the dollar and gold are not moving in opposite directions. So we don't think the dollar strength or weakness is going to be a major effect on gold prices. We do think that investors' fears of lower or higher dollars will have an effect in driving investors into gold and adding to the upward pressure on prices. Longer term, the dollar is a flip of the coin right now. You can draw very compelling scenarios in which the dollar continues to be the de facto reserve currency for many years to come. And it has less to do with the United States and more to do with the rest of the world, and the rest of the world compared to the United States, and the currencies and monetary policies of the rest of the world compared to the United States. We have a lot of warts in the US government, but we have fewer warts than a lot of other places. You know, there was a joke that I promised my wife I wouldn't tell about the difference between Joe Biden and me. And the difference is he'll mutter under his breath, "I'll tell you to your face what I think about you." And the US government has a lot of problems, and it has a lot of resources that if it had the political will, it could solve. Problem is the political will is missing in the government right now, and it's missing in the broader society. And the government and political leaders show no sign of having the capacity or the interest in getting that right, and then dealing with the fiscal problems that really are weighing down the US government, the US economy, and the dollar. Equity markets. Okay, we had an interesting week. We had a 1,000-point drop in the Dow Jones at one point, followed by a $1,100 point recovery the same day. You can see that I'm looking at the S&P. You can see the sharp drop over the last week in the S&P. You can see it's gotten down all the way to levels that it was at in the third and fourth quarters of last year. But take a deep breath. Think about what you're looking at. Take a walk down the hall. Think about it while you're walking. Take a longer look at where we are. This is that enormous drop that we saw this week compared to where the S&P and US equity markets have been since 1982. And, you know, okay, only since 2008. Oh, only since 2015. So then volatility of the S&P 500, the VIX index. Look at how volatile the market has been this week compared to how volatile it's been at other times. Yeah, 2008, 2009 was a bad time, and the equity market was pretty volatile. 2011, 2012, 2020. But, you know, we're at levels that are elevated, but they're not crisis levels. Fear of big numbers. Back here, the S&P was 1/5 of the level that it was, and a 20-point move, a 20% move, was a smaller number. Over here, a 3-point move, 3% move, is 1,000 points in the Dow Jones. And you say, whoa, that's really scary. If you look at it in percentage terms, it's less scary. If you look at it in terms of the volatility, it's less scary. So we're looking at the market and we're saying, yeah, there are problems. Yeah, there's a lot of uncertainty. The biggest problem facing financial markets, including gold and silver, is the uncertainty that investors have and the emotional reaction that investors are having to changes in monetary policy and other developments. There are some people who made a lot of money this week. They did it by having puts in place on the US equity markets, and they did it by buying when the Dow Jones was off 1,000. And they went home wealthier that day. And the people who let those fears wash over them, who listened to the trolls on the internet, they went home sad. Real research at CPM Group. We have our next open forum for clients on Tuesday, 22nd of February. open questions. We don't necessarily go into it with any prepared presentation. If clients want, they can send questions ahead of time to info@cpmgroup.com. That gives us a chance to look at them and possibly pull in some charts to use in the explanations. But the clients will also be able to ask questions during the forum and as it goes. So if I say something stupid, somebody can say, hey, wasn't that a stupid thing that you just said? And we can say, oh, yes, it was, or no, it wasn't. Go on. On March 15th, we are going to have our energy and metals seminar. We had our Platinum Group Metals seminar this week. We had a very good response, and we had a lot of questions. Ran a little bit over an hour. You can watch it on YouTube. And we will follow that up with a slightly broader one, energy and metals, where we'll look at energy markets and their effects on PGMs, but also their effects on silver, which are far less than the silver promoters would tell you, and also manganese and hydrogen and cobalt and other metals and materials. And we'll also probably talk about what we see as a growing bifurcation, not only in the energy markets and the metals markets and the vehicle markets, but also on other levels, a bifurcation of the world between China and other parts of the world, which unfortunately probably isn't going to be reversed because there's a political will not to reverse it on the part of several governments in the world. You can buy our yearbooks. We will start our yearbook series for 2022 in early April with gold, early May with silver, June for the PGMs. You can buy our monthly precious metals advisory, our research, our retail investor program, and a variety of other things. You can read about all of our services at www.cpmgroup.com. Thank you. Have a good weekend. Here in New York, we're looking at a fair bit of snow over the next 24 to 36 hours. So it'll be a winter wonderland here. Enjoy yourself wherever you are.